Good evening, everyone. This is Joseph Trevisani for Worldwide Markets on what has been billed, of course, as this hugely historic day for the Europeans, for the British, and for the European Union. Truthfully, I think it would only be historic were the British vote to leave. Nevertheless, it is the first time, really, not quite the first time, but almost the first time, that the European Union, certainly the first time in the past decade, that the European Union has been put to a popular vote in the country that, by many standards up until now, had been the most Eurosceptic. Although recent polls that I have seen in France and in Greece, of course, and in other countries, Denmark, I believe, on what their opinion is of the European Union, the positive is even lower than it is in Britain at the moment. Let's take a step back. As everyone knows who comes to these webinars, if anyone has any comments or criticisms, or as I always ask and never get, jokes, please put them in chat and everyone will see them and we can all laugh together. I do like to conduct these with as much input as possible from the audience, knowing that it is scattered around the world, courtesy of the web, which I find still endlessly fascinating. We're looking at a start of the chart of the sterling, and I have a number of charts, and they all basically say the same thing. No one in the markets believes that Britain will vote to exit the European Union. That is the sterling chart. I didn't put a date on that. The other ones all have dates. 4013 is, you can all guess what date that is. It's June 16th. It's the day of the unfortunate, very tragic murder of the Labour MP, Joe Cox, by a man who has been reported to be mentally ill. I'm sure that's the case. Whether that is the result, whether the movement we've seen is the result of that, or what I have always thought a more likely movement to remain in the closing days. My logic on that is quite simple. People are inherently conservative. They don't like change, and in this very much. And this would be a huge amount of change, a conditional leap into the unknown as far as things go. The Remain side, the government side, David Cameron's side, has made a point, which I think is telling as far as how they view this, that they decided that the best way to approach this vote was to emphasize the negative, all of the negative aspects or the negative possibilities and potential for Britain, for the British economy, if they decided to leave the euro. The most telling fact from that side is that they did not choose to accentuate, as the old song goes, accentuate the positive. There are two reasons for that. One, because they thought scaring people would be, and I'm sure they believe this to some degree, would be more effective. And two, there isn't all that much to say, perhaps, positive about British membership in the euro, in the European Union. Either way, markets have made their judgments. I mean, a good portion of this has been the two most recent polls were 2 points and 4 points, I believe, toward the Remain side. And as I said, I think that the portion of the population, portion of the voters in Britain that are for leaving are more, or were more aware of their feelings and considerations to start with, more vehement, if you will, perhaps, And the people undecided who are making their final decision and will undoubtedly sway the vote one way or the other will come down on the more circumspect choice. And the more circumspect choice is certainly to stay within the euro. You can make an analogy here, or at least a comparison to the state of several votes in Greece. And Greece has far more to complain about and than the British do, and yet the Greeks themselves did not choose in any capacity to vote to leave the euro. So the natural inclination, I think, of electorates, unless under extreme duress, is to remain with the status quo. A quick summary of what I'm going to do is I'm going to summarize what I think are the salient points on both sides. Then we'll talk about some of the facts of the election. Of the referendum, how it's actually transpiring when the polls close. The polls close at 10 o'clock in Britain. How the reporting will be and some of the other facts of it. What we can say right now, and let's take a look at another chart. All these charts are the same. I mean, every one of them shows the same. This is the FTSE, the British. I mean, everything here is the same. Okay, you know what date that is? That's June 16th. That's today's come back a little bit. Let's take a look at the DAX, the German. Surprisingly, none of these dates came through. Anyway, sorry, let me keep going here. Okay, this is the DAX. We have exactly the same pattern here. It's not only the equity markets and the currency markets, it is also the, the credit markets. British gilt, the 2-year. June 15th, the day before Ms. Cox was murdered, today. Let us look at the US. Same thing. I mean, these charts are all exactly the same. Clearly, there was both a large amount of concern in the markets prior to this event, and there has been a large amount of recovery, of reduction in concern. Let's look at the last one here. That's the US, and this is the German 2-year. It's less negative, yeah. Okay, the German 2-year, less negative. So the market's view on this referendum is uniform. Right down the line. We've just seen all of the comments. Let's put the sterling back up. Now, I just looked at the price movement before I came in, and you can see that it's gone down further from when I made this chart. When I walked in here, it was about 47.50. You can see the huge illiquid run-up. A lot of that run-up started last night, right after the close in New York, into the early, the most illiquid part of the market, the early Asian market. And you can see we've had quite a comeback from that. My guess is, at least as far as the currencies go, that this is the move we have seen. We then start over. If the referendum fails, if the British choose to stay within the European Union, and just as a commentary, I think David Cameron's choice to put this referendum to a referendum is absolutely the right thing to do, because it puts the continued membership on an irrevocable vote. No one can mistake. No one can say that they couldn't have participated if they want to, and no one can say that their vote was not heard and counted. And that is the way democracy works. It is interesting that we are moving more towards referendum for topics like this, which I think is something that governments are often reluctant to do, preferring to keep, even democratic governments, preferring to keep decisions in the representative mode rather than in the referendum mode. Nonetheless, this will be a huge boost for the European Union and, in a way, for the euro, which these days could certainly use some positive news. So as far as the currencies go, I would say that we have seen the positive movement. If the referendum does fail today and Britain chooses to stay, I don't think we're going to get a much more movement higher in the sterling. This is quite a move. Let's just look at the calculation. Even if we go right to here, where it is now, that is a 5.5% move in a week. That's fun and games. I hope you're all long hope you went long when the news came out of Ms. Cox. So what are the implications if the polls are correct that Britain stays? I think there aren't that many hidden implications, which is, of course, one reason that the markets have reacted as they have. It's always been my opinion that the potential disruption from a British exit or choice to exit would be far, far less than certainly than the Remain side wants the British people to believe, and then I think that is the general opinion. Because after all, if British voted to leave, what would be the immediate result? Aside from, of course, market gyrations. Absolutely nothing. Nothing would change at all. Because the terms of the departure would have to be negotiated over the next several years. No one knows how that would play out. And so the immediate effect would be zero. And I mean immediate for 6 months. The people who would be doing negotiation on the British side, the exchequer people and the other members of the government, are by and large in favor of Britain staying. Certainly David Cameron's government is in favor of British government staying. So all of the directives that would come out of how the negotiations are being forced. I mean, the government wants to stay. They're being forced potentially to do this by their own people. Now, of course, in the British parliamentary system, there's a reasonably good chance, I would think, that Cameron loses the prime ministership because of the loss on this vote. I think it would be rather hard for him to stay for any amount of time, in which case you end up with a government, perhaps headed by Boris Johnson, the former mayor of London, that would have a very different attitude towards, a much more contentious attitude towards the membership and how to do negotiations. But nonetheless, a large portion of the permanent civil service and everything else is for staying, and that would be a large factor in the negotiations, how they're conducted. So the immediate impact of Britain leaving would be zilch, zero, except in the markets. If, in fact, the vote does go the other way, I mean, all of the polls, the pollsters say that it's too close to call, but part of that is because the current lead in the last two polls is pretty much within the margin of error for anything. So anytime you get a result like that in just a few polls, it's clearly not something that the pollsters and the others who write about these things are going to come down on one side or the other. So we have a vote that will be most likely very close. Fascinating stuff. I mean, it really is. I will be here. I'm going to be here in the office. Thursday is my night at the gym usually, but I think not tonight. So if we get a Remain vote, I don't think you're going to see a great deal of change in any of the charts that I showed you. The markets have made their movement. I mean, you might get the sterling up a figure or so, or maybe even a little bit more, but no large move. I think the large moves in all of the markets have been made in the past week. Part of it psychological, part of it considered opinion, part of it poll-based. If, however, we get a departure vote, now the other prognosticator factor in this referendum is, of course, the British legal betting parlors. We don't bet on that kinds of stuff here in the United States, at least not legally. If you want to gamble, you have to go to Vegas. Well, never mind. Not a topic that needs to be discussed right now. Those shops have it heavily skewed towards a successful Remain vote. Now, there are two reasons for this. There was a fascinating, I thought, article in Zero Hedge, a website here out of the United States, sort of an alternative financial website, which has some very interesting stuff on it, has some pretty wacky stuff on it too, but it's one that I check in with pretty regularly. The way the brokers work, remember, these people have to be right to stay in business. They have to get the right odds. So the odds are determined not just as in voting by the number of people opting for one side or the other, Remain or depart, but by the size of the bets. Because the higher the amount wagered on one side or the other, the more they're going to reduce the odds for that side winning so that their payouts don't get completely out of whack. So the last thing I saw before I came in, I think it was from Ladbrokes, one of the British brokers. Having been to London many, many times, I will say that I have never placed a bet on anything in a British betting parlor. I will also say that having been to Vegas, Las Vegas here in the United States many, many times, I have only gambled twice. On two separate occasions, I put, I think, 2 quarters or maybe $2 each into 2 slot machines. That is my entire personal acquaintance with legalized gambling. Not a comment, just a fact. So when I came into the webinar to prepare, I saw that the odds at one of the broker shops in London, one of the betting parlors in London, had dropped to 17% for Remain. 17% for departure. But remember, that is determined by the combination of the bet size and the number of people betting. It is, and it was admitted, this is not simply from Zero Hedge, this is from one of the betting shops, I think it's Ladbrokes, yesterday, that the average bet on the Remain side was more than 5 times as large as the average bet on the departure side. So that is where the odds come from. Because the betting is heavily, the amount that Ladbrokes has to pay out on is heavily skewed to the Remain side. I imagine all the people in the city are making big bets on Remain. After all, that's what traders do. The actual numbers are heavily skewed the other way. And this is from, as I said, I think it's Ladbrokes, that the actual number of bets, disregarding the size, the simple number of people plumping down on one side or the other of the decision, was actually 62-38 for departure. So when you look at this as a precursor or an indicator for the election, the referendum, excuse me. You have to keep that in mind. Every vote is worth one. Every bet is not equal. So the two are not necessarily comparative. Now, is the pool of people betting at the legal parlors in Britain representative of the election of the electorate? In that case, I have absolutely no idea. My guess is it's not. So neither one or the other of the two figures coming out of the betting parlors really tells you very much about the electorate. The fact that many more people with money, probably from the city and the financial industry, are betting on Remain doesn't tell you very much about the electorate. And the fact that the pool of bettors across Britain is skewed to the Remain side, to the departure side, doesn't tell you very much about the electorate either, unless it matches the voting patterns of the electorate. So we're back to the polls. I remember, I think I've mentioned this once or twice before, when I was in London the night of, and I was out actually on business. It was a very lively night in the city on John Major's election. Something can help me remind me what year this was. It might have been 92, might have been 94. I'm not 100% sure. I can do what we all do, which is look it up for you as I'm talking, which I will do. And that was also very much expected to be a victory for his opponent, Neil Kinnock. Hold on. 92, I was right. Okay, cool. And it was very much expected, and everybody in, I was out in some of the pubs in London and restaurants, and everyone in the financial industry was very, we went out early before the return started to come in, was very depressed because they very much wanted the Conservatives, the Tories to win, and everyone expected, I think it was Neil Kinnock to win. Everybody was feeling probably more around the country. The idea was that people were tired of Thatcher and the Conservatives and John Major being inherited of Thatcher's. But in fact, John Major won quite handily. So it turned out to be a very lively evening that went on far later than it should have, because everybody from the financial industry was in pretty much the same boat as for whom they had wanted to win the election. And you're seeing a similar thing now. The variables and the potential for the financial industry is unknown if Britain does vote to leave. No one knows how that will play out. And so the greatest concentration of concern, and finance is a huge business in Britain and in London. It is the industry in London, as finance is in New York. Britain is, if there is a world financial capital, it is London. New York would be second on that. It's certainly the greatest volume of foreign exchange trading goes through the London market. And that could potentially be a jeopardy. My view on that is that it's absolutely not true, because almost all of the advantages that London has, it would retain. It would be in almost no one's interest to start throwing up trade barriers between Britain and the continent and the EU. And I think even if there was a certain amount of resentment and perhaps even vindictiveness on the part of the remaining EU bureaucrats and elected officials and unelected officials, I think that would dissipate quite quickly, and it would not have that much effect. That's my own personal opinion on this. However, the markets are not going to view it that way. So now let's look at, so we know where we pretty much are with the markets, where they are and where they, I think, will remain should the referendum to leave the European Union in Britain fail. What happens if it succeeds? This is where I think it gets much more interesting. Let's start with the cable. The low that we saw back on June 16th at 40.13, would that be at risk? In my mind, in the immediate aftermath, it absolutely would be. The risk right now in the currency markets, in the sterling, is all on the downside. Markets have already priced in, I mean, it's very obvious, look at this chart. Markets have already priced in the referendum to fail. They absolutely have not priced in the referendum to succeed. In addition, the market's fears and the market's own, the traders' own opinions certainly play a part in this. Where might this go if at, see, 5 o'clock New York time, the polls close. I'm going to go through some of the other facts before we close about the election, just so you'll know. And I'm going to get some of these facts, again, from a write-up on Zero Hedge. I like to give credit to people who do the work. If you're interested, there's a very good write-up on the facts of the article of the election in Britain on Zero Hedge, and I advise you to go take a look at it. But I'm going to be quoting some of those and some others too, some things from my own research about the election. So we all know where we're starting at. But anyways, I'm planning on eating in the office tonight and doing tweeting and all sorts of other things, posting on our websites as this goes through. But to some of the charts, let's take a look. The low here was, I believe, about 38 or so. I'd have to look at that. I forgot to look at that before I came in. My apologies. But as far as the low from where the sterling might go, I mean, the sterling is a very volatile currency, as we all know. I have traded sterling in the old days in the interbank market. Been the sterling trader, and it is. It's not quite like trading other currencies. If your P&L is counted in dollars, as I was working in New York at the time, it was, then the points, as they're called, are very expensive, much more so than other currencies. So a move in the sterling when translated back is 1.4 right now, or 1.5 times what it is a point in dollar-based currencies. Just so that, so sterling was a very wild currency to trade. Also because as I was working for a Swiss bank at the time, we did not have a lot of good inflation and very little order book in the sterling, yet we were a market maker in the sterling. That means we would make prices to anyone who wanted a price in the sterling, including all the British banks. There's nothing quite as nerve-wracking as making a 20 or a 30 or a 50-pound price to a British bank when you're sitting on a Swiss bank desk and it's your P&L on the line, and it's very likely that the British bank is out there asking 5 other banks for the same quote, knowing the market's going to take off as soon as they all deal. Nonetheless, that was the job in the day, and it was enjoyable in its way. As far as assessing what you would see, because 2 things are involved here. One, we've already traversed the area from 40.13 to 49.50. So just as a estimate of fear, we go back to 140.13. When you compound that, however, with the immediate unease and speculation as to how this might play out, which no one knows for very good reason, because it's never happened before. Not only has no economic bloc as complicated as the euro happened before, as the Eurozone happened, as the European Union happened before, no united currency, such like the oh, what am I kicking against here? Sorry. Like the euro has never happened before. So in addition, never happened before. And of course, no one's ever left them before. So the ramifications for this are largely, one might even say completely, unknown. And we all know the cliches about the markets and uncertainty. So if the referendum to leave passes, my guess is that 4013 is nothing but a way stop. 4013 would probably be the immediate pause point. Remember, through this period right here, especially right here, which I think that's 16th, on the 18th, there was not a lot of volume going through as that move went through. So when you reverse, if you reverse, there's going to be very little to stop any sort of movement on the downside there. Okay? So it would be my guess that 4013 would be nothing but a waypoint on the way down. You would start to get and you've heard some of it from Wolfgang Schäuble, the German finance minister, you would get, I think, initially a good deal of very unpleasant rhetoric out of the EU. I don't think they would take kindly to this. I don't think they would be pleasant about it. The rhetoric up till now has been very muted for very good reason, even though Mr. Schäuble did say a few things that were rather straightforward. That nobody in the EU, and the EU very much, I think, wants Britain to stay. Nobody wants to encourage people or annoy them or anger them by starting to sound dictatorial and vengeful before the referendum is voted. But if it does pass, then I think you will see a good deal of negative commentary out of all sorts of members of the European Union. And these will only play into the market's fears of how this plays out, the potential problems for Britain, not to mention the potential problems for the European Union and for the euro. So I think you will get a rather swift descent through 4013, and where it stops, I'm really not sure. If I had to have a guess, I would do it for no other reason because it's a round number. I'd say 1.3. That's another huge move. That would be a 10% move in a matter of days or even weeks. That's about as volatile as foreign exchange gets. And it would be very risky. So that is certainly a possibility if Britain votes to leave. Now let's take a look at some of the other considerations. We'll take a look at gilts. This is the British 2-year. They call them gilts, as the Germans call their bonds bunds. That's a pretty substantial move. That's a very substantial move for the bond market. What would be an immediate effect of a departure vote? Well, what have we seen since the financial crisis? And what is the historical prime role of central banks, the lender of last resort? I think you can be assured that I read yesterday that Janet Yellen and all the other central bankers, except maybe for Mark Carney, who's probably still in London, are all gathered in Bern, I think it is. That would probably be the BIS, Bank for International Settlements there, the central bank's bank. And what are they doing there? Well, they are standing there and they're hoping and praying that the British choose to stay. But after that, what they're doing is contingencies. And what they're planning on doing, if the British vote to leave, is unleashing liquidity, as if they haven't done enough already. If that happens, the British vote to leave, I think you will see interest rates take a hit around the world, deliberately so. The standard response of central banks, as a matter of fact, their only response to anything that's dangerous is to increase liquidity, so reduce interest rates. It doesn't do anything, or very, very little, for promoting economic growth. That's not going to change. But it does have capacity to avoid terrible responses. The standard response, the standard Keynesian response, the one that Mr. Bernanke criticized the American Fed for not doing in the Depression, is liquidity. So, in addition to the sterling looking for a parachute, interest rates. Bond prices will go up and yields will come down. Britain's financial role, the city's financial role, should not be in the world economy, should not be underestimated. I don't really have any figures on that. I'm sure someone does. Probably not a lowly economist like me. And there is no coincidence that Janet Yellen and Mario Draghi and the rest of the central bankers are all having coffee and tea and probably not alcohol together while this vote takes place. This vote's been known since February, and the plans have been in place since not long after that as to what they would do. So keep that in mind as a consideration as the evening progresses today. Let's take a look at the euro. Less of a move, but I think we will see, could easily see the euro as this plays out back to 110. My guess, over time, it would end up to its lows of last year, back at around 105, 106. Again, the amount of uncertainty, as I said before, long term, I don't think this actually is as dangerous or frightening to the world system or the British economy, the European economy, the primacy of the city as a financial center. I don't think this is really nearly as big a deal as has been portrayed, certainly by the people who are campaigning for Britain to remain, but by also many analysts. As I said, the interests on both sides of this divide, should Britain choose to leave, would be to minimize the disruption and to limit the vengeance. What will the changes that will take place will be stretched out over time, and they will be largely determined by the private sector. Unless Europe decides to start erecting tariff barriers in services and other things, which I do not believe will happen, because it's to no one's benefit, then it will actually be decided by the markets over time. I am sure that the financial services firms in London and on the continent and here in the United States as well have been looking at this to some degree. But unless and until there are substantial changes in the regulatory, legal, and international environment between the two parties, they don't have a lot to work with as far as what changes may come down. So the debate will then move, and the consideration will then move to other areas, to the enactment. And these will impact and have the potential to continue the pressure on the sterling and on the euro. Neither one of these, they're not moving in concert. The move higher in the euro Let's just take a look at it. Remember, it was 5.5% for the sterling to the top, to where it is now. So it is in the euro, it's 2%. It's less than half the move. But the downside potential is very real. And the primary driver will be the uncertainty, of course, because no one knows how this, and the impact of the rhetoric, as I said, that you're likely to start hearing from both sides. Adinda, I just want to know if we're running 45 minutes or an hour today. So just type it into chat if you would, let me know. So the potential here, and I'll just show you another chart here. This is kind of interesting. Euro sterling, I like this one. So you can see, of course, that the sterling has gotten much stronger than the euro, and of course the euro sterling rate has gone down. Do we get potential back to here? I don't think so. I think it would end up probably going the other way, because if this happens, now let's take a look at, just as an example, the FTSE. Because the potential movement, as we have seen up till now, remember the markets are telling us already what they've done and what they're going to do. Okay, thank you, Dinda. So we know. So anyway, the potential movement in the sterling is far greater than the potential movement in the euro. Even though I think economically, there's not that much of a disparity in the impact, I think the psychological impact, we'll put it this way, the potential actual economic impact on Britain is probably greater. Certainly the potential impact on the sterling is far greater than the potential impact on the euro. However, the psychological impact, I think, over time on the EU and even on the euro is far greater than people realize. Britain's the 5th largest economy in the world. It goes United States, China, Japan, I believe Germany, and then Britain. This will be a huge, huge setback. And again, the reason we have to talk about departure is because we know what happens if Britain stays. Basically nothing. Nothing changes. There won't be any economic impact. The sterling may go a little higher, the euro may go a little higher, and we're back to where we started from. Sort of like the vote over the Scottish independence. What happens when they reject it? Well, nothing. And we've already seen that move. So in order to assess the potential for the future here, we have to talk about and spend most of our time talking about the impact of, if not quite the black swan event, certainly the gray swan event, Britain deciding to leave the European Union. Over time, and I think when I say over time, I mean not immediate. If the referendum passes, the reaction in the markets is going to be immediate. Sterling is going to get slaughtered. The euro will be hit hard. We will see I think, sharp rise in bond prices. I think we'll see a fall in interest rates around the world. Certainly in the United States. I mean, look at the reaction here that we already have. This is the US 2-year. Okay, that's not a huge move, but it's not a small move either. I mean, it's clearly not as big as this move here, okay, when the Chinese were devaluing the yuan, but it's a substantial move. So there will absolutely be ramifications of this, immediate, and the market reactions will be immediate. That's why I'm staying here tonight. I assume most of you are staying up too. The long-term potential, I think, is as damaging, I think, for the euro, for the European Union and the euro. More of that is perhaps political, but it is certainly economic. Because one of the decisions that will have been made is, as I think David Cameron said, in defense of staying, he said, we are not tied to a corpse. One of the criticisms of the departure side is that the European Union is a declining entity. It's clearly declining in population, that's factual. At least many of the countries have a declining birth rate. Its growth has been negligible. About the only thing that seems to be growing in the European Union is the bureaucratic diktats coming out of Brussels. So this will be, if it passes, reviewed over time, and I think very shortly, although not immediately, as a rejection by its second largest economy of the principle and also the fact of the lack of success of the European Union in bringing economic growth to its member nations, except for Germany really, and its populations. One result, I think, of the financial crisis and starting in 2011, the Eurozone crisis, this currency, has been, I think we have put off for probably close to a generation, unless something changes, the chance of any of the major Eastern European countries that are now part of the European Union, but not part of the euro, for joining the euro. The Poles are not going to join the euro. The Hungarians, the Romanians are not going to join the euro. Greece and Portugal, and to some degree Italy, are shining examples, as is Britain in reverse, of the reasons for retaining control over your currency and over your own interest rates. The question will soon come to the fore, and the focus will not be on the free trade aspect of the European Union, which I think is almost an unalloyed good. It will be on the political, represented currently by immigration policies, border immigration policies, not internal immigration policies, and politics. The EU, in the vision of its founders, was always, in fact, more so, a political union than an economic union. Its purpose was to avoid a repetition of the horrible, for Europe, Western Europe certainly, and Russia too, events of the first 50 years of the 20th century. Nobody wants to repeat that. And the vision and the idea, starting with the Coal and Steel Pact in the early 50s, was always focused on the political, on a United States of Europe, on a federal system. You could say the United States is the model. I don't know if that's fair, because the United States has a uniform culture, relatively speaking. I know people in various parts of the country may disagree with that, but compared to Europe, of course, that's true. We all speak the same language. So the Europeans' focus and goal of the EU has always been political. It has caused one of the problems, one of the major problems, of course, for the European Union has been the euro. Without political unity, it's very difficult to have, and you might say cultural unity as well, but certainly financial unity, it's very difficult to have a economic union. So the long-term results, if the British choose to leave, I think are as damaging and as changing for the European Union and for the euro as they are for Britain, which is why the potential for this vote to affect markets in the medium term, I think, is probably greater than people realize. The immediate reaction in all the markets, we've already seen which way they'll go. I mean, there isn't any mystery in this whatsoever. How violent it will be, how extensive is pretty much unknown. But I think that the long-term reaction could also be quite negative. Now, the thing we have to remember is central banks and governments don't like volatility and they don't like uncertainty. It's bad for the economy. People get uneasy. It's bad for the currency. It's just not good all around. And so even though there might be a great deal of resentment on the continent and perhaps in England as well, maybe over rhetoric that is yet to come, everyone's goal will be to reduce the uncertainty and to reduce, because the markets are going to be punishing if this passes. And everyone will want that to be limited in time and minimized in effect. So even though we're likely to get some heightened rhetoric, shall we say, it will be reined in very quickly. Central banks and governments will then go about doing what they do and what they want to do, which is creating stability. So that's the potential, I think, for the market. As far as excitation goes, excitement, we have to plump for, aside from whether it's the right thing or not to do. And I've deliberately not given my opinion on this. I don't think that my opinion on this should be a part of what Britain should do, should be a part of this webinar, so I've deliberately not given it. Okay, now let's move on to a little bit about the mechanics of this election. She'll be aware of how things work. The British don't actually use exit polling as we're used to in the United States, where they start making projections very quickly because based on what people say. Exit polling in Britain has usually measures the swing from the prior vote. Hold on. Let me put up what we're talking about in general here. My screen just dumped on that. Okay, that's the sterling, of course. So the British exit polling tends to look at a swing from prior voting, which if you're looking across the country and you see a swing one way or another, since the parliamentary system works that way, it's very predictive. However, that doesn't work particularly well when the last referendum on British membership was 1975, which is 41 years ago. So Britain votes not by machine, but by hand. And I'm reading some of these facts here so you know. There are 382 local areas counting. And then they'll be put together in 12 local area. Polling is from 6 o'clock to, it's from 7 o'clock, New York time, it's 7 o'clock to 10 o'clock. GMT, I think it's 6 to 21. There are particular areas in Britain. I read here that Sunderland, remember that is? I went out with a girl once named Sunderland. It was a long time ago. Will count first. So as with the United States and any other place, The early returns are not particularly indicative of how the nation and the area will vote. But since the Labour Party is strongly for, they're very much in the minority in Parliament, but the Labour Party is strongly for remaining in the European Union. Votes out of traditional Labour constituencies, if they come in strongly for Remain, will give an indication that the Labour voters are coming out to support this. If they are not, then that is an indication that the referendum may have a better chance of succeeding than most people think. For the Conservative side, for the Tory side, the party is essentially split. I don't know what the percentages are between those who want to stay and those who would like to go. So we won't have nearly as good an indication from that. In other words, the Remain, in order for the referendum to fail, they need a strong, consistent Labour vote. If the Labour vote is either sparser than expected or skewed differently, there could, in fact, be a better than acknowledged chance at the moment for the referendum to succeed. Okay, folks, we are at the limit here. I plan, at least for Worldwide Markets and for FX Street, I plan to eat dinner in the office tonight. I plan to be here for a considerable amount of time tonight. I do not expect this to be a call 5 minutes after the polls close, and I haven't had looked forward to such an election in quite some time. So it should be fun tonight. It's going to be phenomenally volatile as various returns come in. So let us all have some fun, watch your back tonight, and let's enjoy a market function like we haven't seen in some time. Again, thank you all for attending. I do take it as a great compliment that people come to listen to these webinars. Everyone have a good day, have a good lunch, get some extra coffee, and prepare. Take care, everyone.